In this series of videos, we'll be talking about a particularly popular piece of household finance, otherwise known as insurance. Insurance has become remarkably popular in the last few centuries as households have attempted to try to safeguard themselves against various kinds of negative outcomes, whether this is damage to a car that they own, or replacement of goods in the event of a fire, or even helping their dependents after primary earners in a household have passed on. These kinds of contracts are effectively a conditional payout that allow households to safeguard themselves against various kinds of negative outcomes. Now, it's worth noting that in the absence of an insurance industry or access to an insurance industry, households generally have to save huge amounts of cash in order to effectively self-insure themselves. Now, there are serious economic consequences to this because every household needs to maintain a vast sum of cash in relatively liquid investments such that in an emergency, they're able to cash out their capital in order to help defray these costs. Now, of course, this means that the money could never be invested into any kind of long-term value creating project because it would need to remain liquid in case of an emergency. And that means that it can't really be put into something like real estate or into a business or any other kind of productive asset. And this means that when everyone behaves in that way, that ultimately the approach of self-insurance limits the amount of capital that's available for long-term investment and thus slows down economic development as a whole. So the introduction of insurance was actually essential to unlocking a lot of value that households traditionally kept to themselves as a way of safeguarding against negative outcomes. With the advent of insurance, however, we've been able to unlock significant amounts of capital that we've been able to make long-term investments with. Now, for those who are unfamiliar, every insurance policy involves a regular premium that's paid, a stated payout in the event that the policy is triggered, and a set of conditions that are necessary for triggering this kind of payout. Now, in order to prevent people from speculating with insurance, it's been required by law pretty much everywhere in the world that coverage can only be taken out by someone who has a particular stake in the risk in question. For instance, I can insure my own life, but other people can't take out a life insurance policy on me for somewhat obvious moral hazard reasons. Now, these types of contracts are also negotiated under what's considered to be utmost good faith, which means that both the insured and the insurer are required to reveal any kind of material information about the probability of both a claim being made and the surety with which a claim will be paid out by the firm. In general, failure to report relevant information to your insurer can result in a loss of coverage, meaning that you've paid for your insurance, but ultimately acquire nothing. One of the common areas where this occurs are people who casually smoke, who inform their insurers that they, in fact, don't smoke. If this is determined to be the cause of someone's death, there's actually been situations where smokers who claimed to be non-smokers had their life insurance policies denied. So if that's the case, I'd encourage you to just come clean and tell the truth to your insurer rather than risking potentially leaving your loved ones or dependents in a bit of a lurch. Now, on the other side of the equation, insurers are required to provide very clear contract language, where there have been cases where when people have been unable to understand the terms of a contract, judges in general have ruled in favor of the insured as opposed to the stronger party, the insurance firm. And so we've seen an effort to try to clean up language and make it relatively less impenetrable for casual users simply because the insurance companies have found that trying to protect themselves through complicated language hasn't worked very well. Now, every insurance contract requires two specialists in particular, an underwriter and an adjuster. The underwriter's job is to try to assess the likelihood and the timing of any kind of payout from the insurance company. They generally use actuarial evidence about the historical incidence rates of various kinds of events, how often there's an accident on a particular driving path, how often people of a particular demographic find themselves in accidents, the life expectancy of smokers versus non-smokers, for instance, the relative incidence of housing fires or of thefts on vacations. All of these kinds of events generate historical data that if we simply count them up, can give us some idea of what the probability would be like in the future. And these kinds of estimates based off of counting historical data are used to appropriately set the premiums that are required of the insured party. Now, of course, not all of the funds that are required by an insurance company are held in reserve. In fact, most insurance companies operate on a basis of collecting premiums and paying out claims with that same money. There is generally a little bit of extra in the premiums above and beyond what gets paid out as claims, and these funds can either be dispersed to the owners of the firm or, more generally, are invested to ensure that the returns on investment can help to subsidize the cash flows necessary to meet certain kinds of obligations in the future. If investment returns are sufficient, then premiums can actually be reduced to some extent. And this has led certain insurance companies to take on particular risks in their portfolio in an effort to drive down premiums in a competitive market. Now, the second important person within an insurance company when it comes to adjudicating policies is the adjuster. The adjuster is basically assigned to any kind of claim to review the conditions that are necessary for a payout and to determine the amount. They're particularly important when people are claiming damages, for instance, or losses in a fire. In these kinds of situations, the job of the adjuster is ultimately to protect the company from fraud and to limit the cost of inappropriately high claims. Now, as you might imagine, the job of an adjuster is not particularly popular because it generally involves limiting other people's claims. But because the claims paid out by the insurance company ultimately come at the expense of other policyholders, what we're really looking to try to do is ensure that there is some fairness in how claims are ultimately adjudicated. People who insist on seeing an insurance company as a piggy bank paid for by others ultimately undermine the entire purpose of an insurance company. Now, one of the things that's generally interesting to people is to consider what sorts of risks could actually be insured. And in this case, they're remarkably wide-based. One insurer recently commented that where there's demand, someone will provide supply. The only question is price. So let's take a moment to examine some of the strange things that have been insured over the years, including the celebrities' body parts. Keith Richards has his hands insured for $1.6 million. David Beckham famously had a $70 million insurance policy on his legs, and Jennifer Lopez had a $27 million contract on her posterior, interestingly enough. But some of the stranger prizes or some of the stranger policies cover prize indemnities, which is an insurance contract taken out by a company that's running a particular promotion. If there isn't a guaranteed winner, then there's only a probabilistic winner. And this means, of course, that there is a probability of a payout, which makes it prime for an insurance contract. So some of the more interesting prize indemnities included whiskey company Cutty Sark, who had bought an insurance contract protecting them from the possibility of a $1 million payout in the event that anyone actually managed to catch the Loch Ness Monster as per their 1971 competition. 30 years later, Taco Bell offered a free taco to everyone in America, over 300 million free tacos, if a particular satellite crashing into the ocean hit a floating target that they put out in place. But some of the stranger ones yet have been related to supernatural happenings. 3 nuns, for instance, actually bought an insurance contract from an insurer at Lloyd's of London to protect against the possibility of immaculate conception. Having sworn vows of poverty, they were worried about the possibility that they might need to care for the Christ child and with their non-income, and as a result wanted a $1 million policy in order to ensure that should one of these 3 nuns happen to become pregnant with the Redeemer, that they would be able to raise him in style, I guess. At a UK hotel that is well known for being haunted, the owners actually had to take out insurance policies guaranteeing that to their employees that if they were harmed by a ghost, and could prove it, of course, that they would be paid out by the firm for having taken on such a dangerous job. But perhaps strangest of all, Lloyd's of London reports that over 40,000 people have actually paid for alien abduction insurance. Now, while this might seem unusual, it's worth noting that many people probably bought the contract for a lark, but more interesting are the conditions required for a payout of this alien abduction insurance. You need to have at least 3 witnesses and a video of the event taking place. To date, it's worth noting, there have been 0 payouts on any such policies.